Hello, welcome back to Father and Son Investing. Today we're going to talk about I-bonds, and we're going to talk about the fixed rate in particular. A lot of people out there are wondering whether the fixed rate will go up on November 1st. We're going to talk a little bit about how I-bonds came about with this fixed rate and the inflation rate. We're going to talk about how the fixed rate is determined in case you want to know the magic formula for that. We're going to talk about whether the Treasury Department should raise the fixed rate. We'll give arguments why the Treasury Department should not raise the fixed rate. I'll give you my opinion on whether I think they will or should raise the fixed rate. And then we're going to talk about a strategy for purchasing your I-bonds through the end of the year in regard to whether the fixed rate goes up. So let's get to it. All right, just a quick history lesson. I-bonds were established in 1998. They were fulfillment of a promise by President Clinton and his Vice President Al Gore to give middle-class Americans a new way to save. To do that, they came up with this I-bond, which is the fixed rate plus the inflation rate. We put those together to get the composite rate, and the intent was to allow middle-class Americans to keep up with inflation. Of course, back then inflation was rather small, and people actually wondered whether it was even worth investing in I-bonds given how low inflation was. If you are an I-bond purchaser, you already know well about the inflation rate component of it. That has been on the minds of lots of people who have been purchasing these particular savings tools. However, the fixed rate is a little bit nebulous, and people don't really know much about the fixed rate. One of the reasons that I've discovered about that in my research is that there's not a lot of information out there about the fixed rate. I believe that when you're looking for information, finding the source of the information can oftentimes be the best way of getting through all of the clutter. So in this case, we will go to the Code of Federal Regulations. I have here Part 359, specifically talking about offering of United States savings bonds, Series I. Should you choose to go to this regulation and type fixed, looking for a fixed rate, you'll see that there are 21 mentions of fixed within this. The initial one you'll find is just from the glossary. The fixed rate or fixed rate of return we see is a component of the composite annual rate for Series I savings bonds that is established, this is important, by the Secretary of the Treasury for the life of the bond. So we get right there who establishes this rate. It is the Secretary of the Treasury, currently Janet Yellen. Scrolling down just a little bit farther, we'll see the question, what is the fixed rate of return? And this is what we get. There isn't a lot of secret sauce here. The Secretary or the Secretary's designee determines the fixed rate of return. The fixed rate is established for the life of the bond. The fixed rate will always be greater than or equal to 0%. I want to call your attention to the footnote now as well. It says, however, the fixed rate is not a guaranteed minimum rate. I think that's important. I think it's really easy to think of that as the guaranteed minimum rate. How could this not end up being the minimum rate? Well, should inflation go down, deflation essentially, that could negate the fixed rate, such that if inflation is negative 3% and the fixed rate was 3%, you would see that your bond would get 0%. But know that no matter what, it can't go below 0% for the composite rate. The answer, therefore, to the first question, how is the fixed rate determined? Purely by the will or inclination of the Secretary of Treasury or his or her designee. That's it. I will tell you that my inclination prior to making this video and preparing for it was that the Treasury shouldn't. However, I did find a very good argument out there of why the Treasury might consider raising the fixed rate. And this comes from Tips Watch. The author of the article is David Enna. In his article, he goes on to talk about what he calls the fairness issue. And he relates that to TIPS, or Treasury Inflation-Protected Securities. That is another way of investing through the Treasury Department and protecting your money from inflation. We won't go into that. Essentially, his argument is that the bulk of I-bond purchasers right now are really just in it for the 9.62% inflation component of that interest rate. And as soon as the interest rate, the inflation-protected component, goes down to 0 or near 0, people will be cashing out. However, there are I-bond investors out there who are holding this for the long run and providing them with some fixed rate, he essentially says would be fair. He goes on to talk about the general spread between TIPS and I bonds and says that in the last 12 years, the difference between that and the fixed rate for I bonds and the TIPS rate has been about 50 to 75 basis points less for I bonds. To illustrate that, he provides a nice table showing the difference between the 10-year TIPS yield and the fixed I bond rate. Now remember I said that for the past 12 years, it's been about 50 to 75 basis points the spread. Right now, though, the spread is about 168 basis points or 1.68%. So we can see that there is a significant change in the current difference than over the past 10 to 12 years. His argument would be that to bring that spread down, the way to do that would be to increase the fixed rate. He further goes on to argue that raising the fixed rate then would be a way to reinforce the idea that really I bonds are best used as a long-term investment and not just by the short-term cash-seeking horde that is looking to get that 9.62% inflation rate. With that in mind, let's move on now to the next point of discussion, why the Treasury shouldn't raise the fixed rate. The fixed rate, while certainly an incentive for long-term I bond investors, for the horde of people who are the short-term I bond investors, that fixed rate would just be a bonus incentive, an incentive that would not necessarily be needed. Just how large is this large population of people who are buying I bonds right now? Well, let's go back and compare to 2021. From a Barron's article published in September of this year, they say, quote, the average monthly issuance of $2.7 billion so far in 2022 compares with monthly sales of just $30 million in early 2021 when the rate was just 1.7%. Doing the math in your head, you'll see that that is 90 times the rate that it was back in 2021 when the interest rate was 1.7%. Therefore, why should the Treasury add extra inducement to something that they're already getting people to buy at 90 times the rate it was previously? Let's get to the next point of discussion, which is what do I think will happen on November 1st? I don't think that the Treasury Department will add anything to the fixed rate on I bonds. I am in the latter camp of the two discussions that we had. I think that it would be a waste of money by the Treasury Department to add to what is already an enormous interest rate on I bonds. Now, with that in mind, let's just get to strategy. How should we go about whether we should buy I bonds now before October 28th, the deadline to get that 9.62% interest rate, or should we wait until November 1st and see whether there is some add-on on the fixed rate, which of course lasts for the life of the bond? Here's the strategy that I am employing. I went ahead and purchased my $10,000 worth of I bonds before the 9.62% interest rate expires. What then will I do if the Treasury Department adds some fixed rate to this newest rate that comes out on November 1st? Well, my strategy then will be to go ahead and purchase more I bonds after January 1st, which of course is a new calendar year and comes with a new $10,000 limit. In the meantime, I've guaranteed myself the 9.62% plus the upcoming 6.48%, which will amount to an 8.2% annual return. Now, to wrap up this discussion, I want to go ahead and take you to an article written by Kent Tuman on Monday of this week, actually. It appears in Deposit Accounts by LendingTree. He goes on to talk about some strategy when redeeming I bonds, and in fact, he actually was kind enough to give us some numbers in terms of the strategy. Now, remember that if you purchase an I bond in the month of October, you get credit for it for the whole month. So even if you purchase on October 28th, you get credit for interest on that bond as if you had bought it on October 1st. Using that principle in mind, he goes on to say that if you purchase, again, by October 28th and decide you want to redeem it on October 1st of 2023, you will essentially only lose 2 months of interest because you purchased it so late in the month of October. That then will leave you with a 7.01% annual rate of return. He's also calculated what would you receive for an annual rate of return if you were to cash in it at 12 months, 13 months, or 14 months. I hope this information today was useful and informative, that you learned something about I-bonds, about the fixed rate, the magic sauce, of course, which there is none, and a couple of arguments for why the Treasury Department should increase that fixed rate and why they shouldn't increase that fixed rate. Please give us a thumbs up if this was useful for you. We'd love to have you as a subscriber. Share this information, please, with a young person in your life. Imagine them earning such great money, great return on something that essentially is risk-free right now. Until next time, enjoy your investing.